Good afternoon, everybody, and thank you for joining us this January for our next installment of our YCharts webinar with Charlie Bilello. Charlie, welcome. Thanks for joining
Thank you,
us
Caleb.
again. New year.
Happy New Year, everyone. I'm still going to say Happy New Year until February.
Sounds good. Well, again, thank you for joining us, everybody. If you don't know Charlie, you should. Charlie has been kind enough to do these webinars with us for, I think, a few years now that we've been doing this, right, Charlie? So always love to get your insights. If if you're not already also following Charlie's blog, that's at a little bit of a new spot, right? Charlie, Bilello.blog now.
Yep,
Am I saying that right?
you got it.
All right.
Bilello.blog,
And follow Charlie.
creativeplanning.com, and YouTube, and all the rest of it.
Yeah, and at Charlie Bilello on Twitter, right? Or on X, formerly known
That's
as
right. I'll
um
never get used to that, but yeah.
I know it'll be tough. It'll be tough. And I'm Caleb, so I appreciate everybody joining. Quick housekeeping item before we jump into the content here. Just please keep in mind that nothing we say today should be taken as investment advice. YCharts is not a investment advisor, and please don't treat us like one. Also, though, if you like the content, and hopefully you do, don't forget to like and subscribe to our YouTube channel, so you can also get other content that YCharts puts out and be the first to know when we have new things on the radar. But all right, Charlie, let's jump in. We've got a action-packed agenda today. We're gonna do a little bit of a look back, look now, and look forward. I think, right? So we're gonna look at some timeless lessons from 2023. We're gonna talk about some things that could shock the markets. Always got to talk about the Fed, so we'll do that. We'll talk about the strength of the market right now and see where that might indicate things are headed next. And then talk about small caps, look at some key charts, and save some time for Q&A at the very end. Sound like a plan?
Absolutely. Let's do it.
All right. Well, let's jump in. So we're going to start with three timeless lessons from 2023. And we almost changed this to four because we have four slides here now, but three just sounds so much better when we're saying 2023. So the fourth slide will be a timely lesson, not a timeless one. Boom.
Absolutely.
All right. So first one, forecast last year were a little bit off.
Yeah, just a bit here. Probably not surprising to anyone, but this should be something that you keep in mind every single year because every single year you're bombarded with these forecasts from Wall Street banks, and their favorite forecast is to predict where the S&P 500 is going to end the year, which is pretty ridiculous if you think about it. On a specific day, you're predicting a target level for an index that has a million different variables that go into it. And lo and behold, Caleb, in 2023, every single one of these big Wall Street banks, their price target was below where the actual S&P 500 ended the year, which was up 24% on a price basis, 26% on a total return basis. And if you think this was a one-off, not so fast. In 2022, what we saw was every single one of these strategists were actually above what the S&P 500 did that year. Of course, the S&P 500 had a difficult year in 2022, and none of them anticipated that either. So throw this out when you're thinking about making investments for a year. Throw out any forecast of where something is going to be in a year's time. It's impossible to do with any sort of consistency. Wall Street is going to continue to do it because it gets the most attention, and people like hearing conviction and certainty when it comes to this stuff. But the truth, of course, is that the range of outcomes is enormous. So if someone asked me, where's the S&P 500 going to end the year? I'd say, well, with a 95% confidence interval, it'll be somewhere between 3,000 and 6,000. And no one wants to hear that, of course, whatsoever.
Not super helpful. I think it's interesting though, because those of us that follow the markets and think about equity risk premiums over the long term, kind of expect there to be a consistent, maybe like 7 to 10%. If you're looking at recent history, or maybe 5 to 7% over the really long term, kind of annual return. But I think you nailed it. The year to year distribution is much more volatile than that, but longer term averages tend to hold up.
Yeah, the smart move for them is to go right in the middle and say 10%. They almost never do that. I mean, it's just too simple. I think there was a few articles at the end of 2022 suggesting that on average they were actually predicting a down year for the market, which is very rare. So typically they're perennially bullish, which they should be because the market goes up 3 out of every 4 years. And if you're going to play this game, let the odds be in your favor and predict that the market's up. But in the last few years, recency bias was really, really bad. So 2021 was very strong. People were predicting that was going to continue in 2022. It didn't. The market had its worst year since 2008. Then recency bias took in on the downside, people saying there's going to be recession, as we'll talk about in a little bit in 2023, and earnings were going to go down. Neither of those things happened. They got caught being too bearish. And this year, it's kind of interesting, Caleb. I don't have the chart here, but the expectations after a really good year last year, you would expect the forecast to be pretty high. I don't think they are. I think the average is around 1.5 or 2% out of the strategist for 2024. So interesting to see that they're not kind of saying this is going to continue, which they normally would do. And obviously, that's well below the long-term average return for the S&P 500.
Well, if we learned our timeless lesson, it's not to put too much stock in those predictions. Let's
Absolutely.
jump to the next one though. Every time is different. So talk about this lesson and why it also is timeless for us to.
This was a shocking one for me in terms of everything you learned about interest rates and affordability and the impact it would have on a housing market. 2023 was said throw all of that out essentially. So one half of this equation I got right, where I said coming into 2023, housing affordability is terrible. We covered that a lot in 2022. It's pretty much the highest percentage of your income you would need to buy a home in history. It means affordability is very, very low. So what you would expect based on that is demand would collapse, right? Anyone who hasn't bought a home yet, if they're struggling to buy a home, they're going to put that off. They can't get a mortgage. Most people finance a home. And that's absolutely what we saw. The demand side went way down. What I didn't anticipate was that the supply side would go down even more. And as a result, home prices actually went up a few percent in 2023. Pretty shocking to me, which shows you every single time is different. Even if you knew what was going to happen, that mortgage rates would hit 8% at one point in 2023, pretty crazy considering not too long ago they were at all-time lows. Now they're at 8%. Say, well, that has to cause home prices to go down, but it just comes back to supply and demand. And that unanticipated factor, Caleb, was that existing homeowners, 60% of whom have mortgages below 4%, were saying, I'm not moving. I can't move because I can't afford a new house at the higher interest rate, or I don't want to move because I locked in this low interest rate and now I have this embedded savings, right? Now that interest rates have gone up, I'm doing okay. My wages are going up and I have this fixed mortgage payment. So that really was the big factor. Existing homes just weren't being listed.
So I
So
guess going forward,
every
the
time
question
is different.
is there
Go ahead,
more
sir.
pent up supply or pent up demand waiting for that downtick in mortgage rates?
Yeah, there's both. So it'll be interesting. So if we see, and mortgage rates have come down a little bit, and so far we have seen a little bit of a tick up in terms of listings, very, very slightly. But what will be really fascinating is if mortgage rates went back down to 5% at some point this year and home prices don't go up, but they go down because we actually see more supply coming into the market. I'm not going to predict that, but that's certainly a possibility based on what we saw last year. And the housing market, Caleb, like this is talk about every time is different. When you and I were talking in 2020, that was really the most incredible year in terms of housing because normally when you get a spike in unemployment, that's the number one thing that you say, okay, home prices are going to go down. Right? People lose their jobs and home prices, that tends to be the highest correlation in terms of predictability. But that didn't happen, obviously, in 2022. The exact opposite happened because the people that lost their jobs were actually making more on unemployment than they were when they were working, which was something we'd never seen before. So throw everything you learned about macroeconomics on their head. Every time is different. This housing example here, it's going to surprise us again in the future. I still stand by the fact that I don't see a huge housing boom in the next 5 to 10 years. Even if it keeps pace with inflation, I think that would be a high expectation. But the fact that we didn't see weakness in 2023, just totally shocking. And another reason why making like an annual forecast is a very difficult and dangerous, potentially dangerous game to play.
All right. Let's jump into the third timeless lesson we learned in 2023. Uh, Returns aren't linear, right? A little volatility on this chart. So what are we looking at?
So we're looking at here 60-40 portfolio. And if you were listening to headlines last year, you probably read the 60-40 portfolio is dead. And most of those headlines were occurring last October. I mean, you had the bond market in its longest bear market in history, at interest rates on the 10-year going above 5%. Stocks were in the midst of a correction there that wiped out most of the gains on the year. And then what happens next 2 months for stocks and bonds? One of the best we've seen in history, 11.9% gain for this US 60-40 portfolio. And it may seem extreme, and it is extreme, but this is an important concept for investors to understand. The 10% historical return that you get from equities is not a straight line by any means. It's very, very lumpy. And you'll see 20% returns one year, we see down years like we saw in 2022, and no one can predict the sequence of those returns. So that's why, as an investor, trying to time your exposure to the markets is so difficult, because you have these situations where just when it seems like things are going to get worse, like October of last year, all of a sudden, for seemingly no reason at all, we enter November and everything just flips.
Charlie, you look at this though and you say, hey, that's awesome. 12% in a 2 month period on a 60-40 portfolio. But isn't that still kind of the problem, right? Wasn't the concern that investors had about the 60-40 portfolios that those two asset classes are supposed to be inversely correlated and they were moving together when they were both going down? Now it seems like they were moving together when they're both going up. Are there still concerns around the diversification method of the 60-40 portfolio in your mind?
Yeah, no question. The correlations we've seen over the past 2 years are the highest for the 60-40 portfolio since the 1990s. So very rare to see stocks and bonds moving this closely together. And the big reason for that is that inflation was all of a sudden an issue for the stock market. And with inflation, you get higher interest rates. Well, that's difficult for the bond market. Now, does that mean you can't hold stocks and bonds going forward together? I don't think so. I mean, unless you think we're going to have a persistent period, I guess, of super high inflation. We'll talk about inflation in a little bit. I don't know what the alternative also is. So, what I was saying to people, yeah, the 60-40 portfolio over the next 10 years, at least definitely in 2020, we were saying this, likely to do worse than the previous 10. Just because of the gains in the stock market. The 60-40 portfolio is usually dominated by the stock side of things. But in terms of the bond market, the 40%, as we talked about in our last webinar, hasn't looked this good since 2007. So the bond side, you should be more bullish. Now, as far as the correlation in the short term, no one can predict that. But giving up on the 60-40 portfolio concept is saying, like, stocks and bonds are just going to be terrible in the next decade or 2 decades. And if you think that, then I'm not sure what asset class you're going to go to that's going to do much better in terms of performance, right? Where do you go from there in terms of cash
We know
flowing
we know you love
assets?
gold, Charlie. So
I'm not a gold hater. I'm just a gold realist. And the tricky part with gold, of course, is that it doesn't give you a cash flow, and over the long run, it's been subpar to both stocks and bonds. That's just the data. And we've gone 20-year periods with gold from 1980 to 2000 where gold was cut in half. And almost no one could stick with something like that over a 20-year period. But the 60/40 portfolio is not dead. It might do worse over the next 10 years than the last 10. That wouldn't be shocking. But just keep this in mind in terms of uh, things can change very quickly in a portfolio, and all of your gains for a year is not uncommon to come in 1 or 2 months of the year. And no one could say going into it which of those months it's going to be.
Sure. All right. I mentioned we had a fourth slide in our three timeless lessons for 2023. This is it. And I guess this is more or less, and maybe we learned from looking back on our own, presentation from a year ago. But this was a poll that we launched this time last year, right, Charlie?
Yes, we did a version of
A
this.
little
This
bit
what
before
we're
that.
actually showing here is a poll I did on Twitter in December 2022, essentially saying, is the economy in a recession or will it be in a recession in 2023? 85% of people said, I agree with that, saying recession's coming. If you look at economists, they were on board with that view as well. We did do a poll similar to this at the time, and thankfully for the audience here, this was a lot lower. There was a lot more people that were optimistic than my audience on X. So the good news is for those people, they were more likely to be optimists going into 2023, and that ended up being the right view. But I thought it would be interesting to run a similar poll today and see what everyone's thinking about the economy. And here's the question here.
All right. So we've got proof from last year that our audience is a little bit more correct or more sophisticated than the bigger Twitter audience. So we'll see how they do this year. But looking forward to the results here. While we give everybody a chance to fill out this poll, Charlie, do you want to? We didn't have it in our plans today, but give a quick commentary on the GDP reading from this morning.
Yeah, so we got Q4 first read on Q4 US real GDP, and it was above expectations once again. So we saw that in Q3, we saw it again in Q4. So 3.3% annualized. The expectation was 2%, so quite a bit above expectation. So at least as of the fourth quarter of 2023, no U.S. recession. This was called really the most widely anticipated recession in history. And so far, it hasn't happened.
All right, let's Alex, if you're listening, let's show those poll results. See what everybody thought. All right. All right, so we've got most people, overwhelmingly, actually, most people expecting a soft landing. Slightly more of them expecting that inflation will remain sticky, but the recession fears seem to be pretty subdued.
Yeah, optimistic group. I like it. We'll see. We'll revisit this in a year.
All right, so if a recession maybe would be a shock, what other things might really surprise investors this year if some trends turned around, John?
Number one has to be the Magnificent Seven. And I'm sure you've heard this term. I'm sure people may be getting tired of hearing it after last year, but these seven stocks had just such tremendous outperformance in 2023 that happened to be, the seven largest companies in the market as well, and they all are companies we use on a daily basis. Um, it's just tremendous. And Nvidia, of course, being the leader in 2023, up 239%, the top performing stock in the S&P 500. Meta was number two, 194%, but all of them widely outperforming the S&P 500 and just killing the equal weight. So I think when you enter a year, forget about the forecast. What I like to think about is, are you prepared in your portfolio for these shocks, for these surprises, which the likelihood may seem very low. I don't know how you handicap whether they're going to underperform this year, but you certainly don't want to have a situation like we saw in 2022 where all of these companies underperformed by a wide margin And that might seem very unlikely, but it could obviously certainly happen again. Now, we're less than a month into the year. All of them are doing pretty well with the exception of Tesla. And I tweeted this chart out, and people were saying we got to kick Tesla out and call it something else with the six. But so Tesla had a difficult earnings report, and they're down 25% this year. But the rest of them, especially Nvidia, is up 26% already this year. So we'll see. There's a lot of time left in the year, but I think a lot of people, if you're asking advisors, what's the number one question they're getting, it would be why shouldn't I just own these seven stocks? And the only answer to that makes any sense is that we've seen throughout history the leaders change and the biggest companies change and nothing outperforms forever. And the only way to protect yourself in the event that the future doesn't look like the recent past is to have something else in your portfolio other than these seven stocks. Now, if you're just owning the US index, what I would say, Caleb, is that you already have massive exposure to these seven stocks. At the end of the year, these seven stocks were 28% of the S&P 500, up from 20% at the start of the year. That 28% was the highest total for any seven stocks in the S&P 500 in history. So really the most concentrated that the index has ever been in just seven stocks. So you already have that. The question is, do you want to overweight that now going forward, even after what's gone on in the last 10 years, which is many of these companies up over 1,000% versus around a 200% gain for the S&P 500. And
Yeah, I think that's one of the more interesting lines of questioning and kind of analysis we've done over time over the last few years, with just that common question being, hey, should we buy Google or should we buy Amazon? Should we buy Nvidia? The truth is everyone owns those things, right? It's, do you want to really go out on a limb and expose yourself? But also with these huge appreciations over the last year, I mean, the growth expectations going forward to maintain this have to be huge too, right, Charlie?
they do. And so if they were trading, let's say at market multiples, I would be a little bit less concerned. But the fact is, all of them are trading at premiums to the market in terms of the expectations, and especially Nvidia. Now, Nvidia so far exceeded those expectations, but it's trading at 35 times sales right now. It has to continue to exceed those expectations if it wants to maintain outperformance. So yes, the expectations, as we talked about with Tesla 2 years ago, I think we did a whole section on it. Tesla was trading at 30 times sales. It was unbelievable at the time. And now you look 2 years later, it's still below that level. And Tesla's executed almost flawlessly over that period of time. Earnings have gone up, revenues have gone up, but the price is actually lower. So no one can predict what's going to happen with this stuff in the short run. What we know from history is that the leaders change and you can't anticipate the new leaders. So Nvidia wasn't, before last year, no one was talking about Nvidia as being part of this group. Remember the fangs? The fang at the end in fang wasn't Nvidia, it was Netflix. And so all of a sudden Netflix is kicked out, Nvidia is put in there, and we got the Magnificent Seven. So I don't know what the leaders will be 10 years from now, but usually from decade to decade, you see the weights of the biggest holdings go down from decade to decade. What's been unusual about the last 10 years is that really hasn't happened. We've seen many of the biggest stocks stay there. But if you look at the biggest companies in 1990, Caleb, not a single one of the top 10 in the S&P 500 from 1990 is there today. And from 2000, only Microsoft is still in there. So it almost seems impossible, especially with these names. Like I use Amazon, Google, Microsoft, Apple every single day. I don't own a Tesla, but many people do. I mean, people are using these things every day. So it almost seems impossible, like we talked about at the end of 2021, for these things to underperform. And then essentially what we've seen is in 2022, massive underperformance, 2023, massive outperformance. And we're kind of right back to where we were at the end of 2021. It's just kind of two extreme years in both directions. And so just have something in your portfolio just in case these things don't continue to underperform. And just go back to 2000 and look at the top 10 stocks there. Look at Cisco and look at those names and look at what people were saying about them at the time, and then look at the next 10 years, and that'll be a helpful reminder that it's important to diversify even when it seems like a stupid thing to do, because it's so obvious that these companies are the best companies, and it seems like they will always be.
All right, so the market will be shocked if they're not. The market will also be shocked if the Fed starts to hike rates again. Is that right? These, I think this chart's showing expectations for rates going forward based on futures.
Yeah, based on Fed funds futures, this is the implied level of the Fed funds rate. This was at the start of this year. It shifted a little bit, but not very much. Essentially, the market was expecting 6 rate cuts entering the year, and the Fed in the December meeting said we're going to forecast 3 cuts. So the market was even more aggressive in saying that the Fed is going to ease, and that would put the Fed funds rate by the end of this year at below 4%. And so, very different situation than we had a year ago, where a year ago people were expecting a few hikes. The Fed ended up doing 4 hikes in 2023, so a little bit more than people were expecting. But today, very much, and especially after that December Fed meeting, people are saying easy money's coming back. Fed's going to cut rates very aggressively. And if that doesn't happen, and or if it's slower than the market's anticipating, I think that would be a little bit of a shock to people, because that higher for longer is not something that people necessarily want to hear if they're wanting that easy money policy. So, but what I would say, Caleb, is it's a very important why the Fed is cutting rates when they do that first rate cut. So people are betting whether they're going to cut in March or May. When are they going to do the first cut? Doesn't really matter. What matters is why they're doing it. And if they're doing it because we have this Goldilocks scenario where growth is still good, unemployment's still low, but the Fed funds rate they're saying is too high and they could lower it a little bit, that's fine. But if they're doing it because they're starting to see signs of economic weakness, then it may not necessarily be so good for the markets. So we saw that in 2007 when the Fed started cutting rates. Initially, people were like, yeah, this is great. Fed's cutting rates. A year later, they weren't saying that. The Fed went from over 5% in 2007 to 0% by December 2008. Market was down 50%. Same thing in 2001. They start cutting interest rates early 2001. It was a recession, starts a few months later. By the end of their rate cutting cycle, they brought rates all the way down to 1%, and the S&P 500 again was cut in half during that cycle. So very much matters why they're cutting rates. What people would like to see is the 2019 type rate cuts where they're bringing rates down, but things are still okay.
Yeah, and it seems like those rate cuts are already priced into the market too. So if they don't happen, I guess the reaction will absolutely be real. But all right, third oh, here we go. Third thing that would shock the markets. Another truth over the last decade has been that US has outperformed emerging markets, right?
Yeah, that's an understatement by an enormous amount. Emerging markets essentially haven't done anything in the last decade in terms of performance, while the US stock market has more than tripled. So enormous, enormous outperformance. What you can see here in this chart, there tends to be long cycles. This is the longest one we've seen, but there tends to be long cycles of outperformance and underperformance. And where we are today is the lowest relative strength for the emerging markets. So just looking at a ratio of emerging markets, the S&P 500 lowest since 2001. So essentially, all of those gains for that huge period of emerging market outperformance, which a lot of people probably on here either don't remember or they forgot, or it just seems like so long ago that it's impossible to happen again. But there was a period of time where all everyone was talking about was the BRICS and emerging markets. Today, exact opposite, and so much negativity. A lot of it seems warranted, right? Too. That's the other thing, right? After you have this type of thing, you dig into it and you say, gosh, it just makes sense. The US has everything going for them. Emerging markets has all this risk and volatility, especially China, which is a quarter to a third of these indices. And you can you can't envision this turning around. So I think that would be a big shock if U.S. leadership didn't continue. And this is kind of tied into the Mag 7, right, as well, because U.S. performance obviously dominated by those 7 stocks.
All right. Let's jump into our next section. So we spent some time already, talking about the Fed, talked about the expectations that rates will, especially that Fed funds rate will start to go down. But it wouldn't be a webinar with you, Charlie, if we didn't analyze the Fed's policy a little bit and maybe pose a contrarian opinion to how they're going to do things. So what are you thinking about the strategy of cutting rates already? Is it too soon?
I absolutely think it's too soon. And just looking at this chart here, you can see we're essentially just starting that restrictive monetary policy. We've been in it now for maybe 6 months, where the Fed funds rate is above the Fed's core preferred level of inflation, which is core PCE. We're about 2% higher than that. That's the most restrictive policy we've seen in the US since 2007. And a lot of people saying we don't need to be so restrictive anymore. It's clear inflation's coming down. You could see the red line. It's coming down. Aren't you an idiot? You see inflation's been solved. The war's been won. And the Fed now is risking a recession by keeping interest rates too high for this long. And that look what this followed though. Okay, look at the period where that red line was above the blue line. Look how long, most of the last decade prior to just the last 6 months, the Fed is operating on ultra easy policy, right? Keeping interest rates well below the rate of inflation. And they were actually cheering on inflation. If you listen, it sounds crazy, but a few years ago, you go to the middle of 2020, and every FOMC meeting was about the Fed saying we need higher inflation. We know that's going to be painful with higher gas prices, higher food prices, but we need it. It's too low. We need to get inflation up to this 2% magical number. Who knows why it's 2%? No one ever asked that question, but that's their magical number. And inflation was running about 1.9%. And for the Fed, that was too low. And what they said at the time in 2020 is we're going to allow easy monetary policy to continue for a period of time to get that long-term average above 2%. So they viewed the risk in their mind in 2020 was inflation's too low, prices are too low, we need to raise prices, we need more inflation, we're going to keep monetary policy easy. Now, why aren't they applying that same logic today and trying to bring inflation back down is the big question.
What's the answer?
And the answer, I think, is on the next chart, but just setting the stage here, the Fed has 2 mandates, right? They have employment and inflation. And for the past year, or the past 2 years, they've been rightfully concerned about inflation because employment's been pretty good. We have 23 consecutive months now where the U.S. unemployment rate has been below 4%. This is the primary reason why there was no recession. Employment continues to grow. Wages continue to go up, as we'll talk about later. And so the question is, why shouldn't they still be focused on that inflation number? And believe the next chart will kind of illustrate what my thinking is here. So is a chart showing you where CPI would be if we continued on that Fed's 2% inflation trend since the beginning of 2020 versus where it actually was. So, and if whether you believe the CPI or not, we don't need to get into that. Many people on here saying the inflation's actually much, much higher. Okay. I somewhat agree that it's higher, but we don't need to debate that. What we can say is that inflation is running 10% above that 2% trend. So it's wonderful that CPI has come down to 3.4%, and likely when we get the January reading, it's going to come down to 3%, maybe even go below it. There's a number of reasons why that's the case. We're going to see shelter inflation continue to come down this year because it operates with a big lag. That's all wonderful, Caleb, but as most people will rightfully say, that doesn't mean prices are coming down. It just means prices are going up less. And if you're really an inflation fighter, and as Powell said, every single meeting for the last 18 months, we're going to keep at it until the job is done. Well, to me, the job is not done until you close this gap. So, which is it? Is this the next Paul Volcker? Does he really care about bringing prices down? Or is it back to the old regime of just we get back to easy money at the first chance we can, and this they see an opportunity here, and they're going back to easy money. So I don't know what they're going to
Yeah.
do, but 100%, I don't think it's time to do it. I don't think there's any need to do it. Leave rates higher for longer until this gap is closed.
But Charlie, the only way this gap closes, right, is either with time and a lot of time based on compounding growth at 2%, it would take a lot of time to close that gap. Or if we actually see prices decrease, which would be a deflationary environment, which also seems concerning, right? So I guess what talk me through like that phenomenon, how you get there.
Yeah. So just allowing it to go below 2%. And I wouldn't mind seeing food prices go down or car prices go down. I think this notion that deflation is always bad is kind of ridiculous notion, because if you look at technology, there's been nothing but deflation over the last 20 years. Like the iPhone that you have in your desk there probably is a similar price to where it was when it first came out, and it's so much better. That's the definition of deflation. If you look at a TV, right, that's in your living room, the price of that is probably 1/10 of what it was, and it's so much better, right? Why? So that argument doesn't make sense to me. Like this notion that deflation is in and of itself bad. Now, yes, if there's just a depression and there's a spiral in prices where they're going down so much, yeah, I know the research. The research is that people are going to probably pull back, and it's going to make it worse because they're going to wait for prices to go down more right before they buy. But clearly that hasn't been an issue in terms of technology. People are still buying technological products, even though there's persistent deflation by the way CPI measure these things, right? So they're getting better, prices staying similar. That's essentially deflation. So all I would say, Caleb, is let it run below 2%. And overall, my view, the Fed shouldn't be playing this game to begin with. Just create some formula where they keep CPI, they keep the Fed funds rate some percentage above CPI. Let's say it's 2% or 3%. Just pick a number and stick with that rather than trying to play these games of managing an economy, right? 10 people sitting in a room shouldn't be deciding the most important interest rate for the largest economy in the world. They've proven every single time that they've gotten it wrong, and this time they're going to get it wrong again, either by cutting too soon or cutting too late, because it's impossible for human beings to do that. Like everyone wants that perfect scenario, that perfect interest rate. The Fed clearly doesn't know it, because in 2020 they missed the biggest spike of inflation in 40 years. They entirely missed it. And even when it was staring them in the face, and you and I were talking about home prices, and they're hitting new highs every single week, and they're still buying mortgage bonds to try to drive mortgage rates lower. So clearly this is
Transit.
not clearly this is not the institution you want setting an interest rate. It would be better to have a bunch of monkeys throwing darts at interest rates, in my view, than these 10 people. And then, and that's no offense to the Fed. No, none of us could get it any better. So either use a data-driven algorithm to say where the interest rates would be, or how about this really crazy idea? Let the free markets determine where interest rates should be based on supply and demand. We do that for everything else. Why aren't we doing that for interest rates?
Well, hey, one thing we do that for are used cars. And you want price depreciation. We've got a little bit right here, right?
Here's your deflation, right? We talked about the used car bubble. It's kind of shocked me that it stayed as elevated as it did for so long. But this would be a prime example that higher interest rates are doing their job. If you want lower prices, you want lower inflation, and many people are priced out of the car market, Caleb, right? Because prices are too high. Well, most people finance the cost of a car. And when you raise interest rates And if you're looking out to borrow for a car now, you're looking at 7, 8, 9% interest rates. For a long time, it cost nothing. People, car companies would say 0% financing, right? You remember all those commercials? 0%. Well, that's
Oh, yeah.
gone. Now you actually have to either pay a big interest payment or you have to save money and pay in cash. And what that does is it causes demand to collapse. And unlike the housing market, people are still selling their cars. It's taking a little while, but it's coming down. So we could show this with any number of things that are interest rate sensitive. But if the Fed really wants prices to come down, as they've said, or inflation to come down, just leave it there a little bit longer, right? And so I don't think anyone's complaining about the prices of cars going down, perhaps with the exception of Tesla owners who are seeing their prices of their their vehicles, and this has been a big issue for people who have leased a Tesla, and they their prices have gone down 30-40% in a short period of time, and that's a whole different scenario. But for the consumer, for people who are coming into the market now, who've been waiting to buy a car, this is great news. This is good news. And the wages are going up, prices are going down. That's the definition of prosperity. So yeah, give me a little deflation. As long as that's the situation, I'll take it.
Well, hopefully Tesla owners also bought Tesla stock. In that case, we've already established that they'll be okay.
Yes.
All right, jumping to the next section. So next section, looking at all-time highs and what tends to come after all-time highs. And I won't steal the punchline. I'll let you take it.
So we're back. I mean, what a comeback. Uh, we did a webinar in, I don't know where it was, early 2022, talking about every bear market is different. I don't know if you remember that one.
Mhm. Yeah.
And we were talking about some of the parallels to bear markets in the 1980s, 1973, 74, and the two ones that people really feared the most were 2000 to 2002, 2007 to 2009. And what we said, every bear market's different. This one is going to be different as well, and it was certainly different than those longer bear markets where it took a really long time to get back to new highs. It seems like a long time. It's 2 years, but given market history, we know it could be much, much longer. So we're back at all-time highs. And what's the big question? What are people saying? Well, there's a few things. One, people always say when you get back to an all high, it's a double top, right? It's a double top. How they know that? They ignore the millions of examples where the thing just keeps running higher. But the other thing people say is buy low, sell high, which I love that saying. I'm a big proponent of that. The problem is selling high. What is selling high? Yes, there will be an all-time high. That's the last all-time high before the bear market begins. But the long-term trend of the market is higher. So all-time highs by themselves are not an indicator of anything. And I think we have some data on that to kind of prove that point. Okay, first, let's look at the drought here. It was only 1 year, so 2023, it was a good year for the markets. We didn't hit an all-time high. Almost got there at the end of December, but didn't get there. Broke that streak. But unlike that gap from 2001 to 2006, no all-time high after the peak in March 2000 and 2008 to 12, no all-time highs. Unlike that, recovery much quicker. Last 4 trading days, S&P back at all-time high. And what does the data show? This is the only thing that should matter to people. What does the data show looking at forward returns on all-time highs versus other days? What you can see here, pretty much indistinguishable looking out 1 month, 3 months, 6 months, 7 months, 9 months, 1 year. Average return over the next year, going back to 1929 from an all-time high, 10.5%. Average return other time periods, so no all-time high, 11.5%. So what do you do with that data? So what you do is say this all-time high doesn't really mean anything, right? Like the market most likely 20 years from now is going to be much higher. There's going to be a lot of all-time highs between now and then. So that fact alone doesn't mean anything. Now looking out longer term, if we look at 10, 20 years, is there some differential in terms of performance? Yes, a little bit. So all else equal, is it better to buy at a day that's in a drawdown versus all-time high? Yes, looking at long term. But the reason for that is these are averages, right? And then you're averaging time periods where valuations are very low and markets are depressed, right? So think about March 2009 and the huge gains you have after that, right? So by itself, don't use an all-time high as a reason to do anything. Buy, sell, anything. It's not a signal of anything. Market tends to go up following all-time highs. And so what tends to follow all-time highs? More all-time highs.
All right. I think so many of us get used to that idea though of, that image where you see investor behavior, whereas the market goes down, they start to sell and capitulate, and then the market goes up and they start to have that feeling of elation and start buying and get into that backward cycle. But I guess the important thing is knowing where that chart's going to go from where it is now, and it might not be at that peak yet. So
Most likely not. It could be. It's like today probably because we're saying this today will be the peak. Will be a
we're
bear
not that we're
market.
not that good.
Yeah, right. But most likely there's more all-time highs to come. That's the best you could say, right? Until that ultimate peak, which is no one's going to predict where no one rings that bell at that all-time high that really matters.
All right. All right. Well, we talked a little bit about how emerging markets have reached their lowest relative performance value to the S&P 500. Another underperformer, small caps. So what's your take on small caps? Also trading at a big discount, I guess, compared to performance of the S&P 500. But is what does that mean? Is there an opportunity here?
Small caps are smaller. We'll say that to begin
All right.
with. No, it's this is the lowest we've seen in terms of this relative strength since December 2000. So it's been a long cycle of underperformance, similar to what we talked about with emerging markets. This is the longest we've seen, right? So everybody hears about, oh, in the long run, small caps tend to outperform. They have higher risk. There's a lot of debate whether that's true or not. And after looking at all the data, my personal view is I don't see it on a risk adjusted basis. There is some premium to small cap value, but not small caps overall. But that doesn't mean that small caps should underperform forever. It just means there's no valid data point saying that you should expect huge outperformance, let's say over the next 20, 30 years. And what we have here, I would say, is somewhat of an extreme in terms of, okay, there's a range where it's outperforming, underperforming. Sentiment is pretty bad. This is the about the worst relative sentiment I can remember. I mean, it's hard to remember going back to March 2000, but it was pretty bad back then as well. In the late 90s, I mean, small caps, very little participation, and you had the biggest tech stocks just absolutely crushing it. So probably was similar back then in terms of the sentiment, in terms of small cap value. So history, they say history doesn't repeat, but it rhymes. It's rhyming a lot, in my view, with that period of time in terms of sentiment. But I think the more interesting thing is this chart right here, Caleb. This is unprecedented in history of the Russell 2000 and S&P. You have data going back to the 1970s here. S&P 500, as we talked about, back at an all-time high. Where's the Russell 2000? Still in a bear market, still 20% below its all-time high. We've never seen that happen before, that big of a spread. And so I went back in history and looked at the three other time periods that had the biggest Russell 2000 drawdown with the S&P 500 at an all-time high to see, well, what does this mean? Does this mean anything? Because a lot of people, especially in the permanent bear camp, are saying this is a negative signal for the markets. Said it all throughout last year because the average stock, and it was true, was just not participating. The last 2 months of the year, that really changed. You had just a huge surge higher in everything, including small caps and the equal weight. So that kind of changed very quickly. But they're still saying it today. That S&P 500 all-time high doesn't mean anything because small caps are still in a bear market. So what happened after these three prior periods over the next year when you had these big Russell 2000 small cap drawdowns with the S&P at a new high? Well, April 1999, S&P 500 gains 14%. Over the next year, Russell 2000 gains 36.5%. February 1991, S&P 500 gains 12% over the next year, Russell 2000 35.5%. And January 1985, S&P 500 gained 17% over the next year, Russell 2000 18%. So not only was it not bearish, seems to be pretty bullish, and surprising probably to a lot of people, Russell 2000 actually would go on to outperform the S&P 500 over the next year.
Charlie, how much of this is just a interest rate play? I think we know small businesses rely on lending a little bit more, and high interest rate environments certainly impact small businesses more than large businesses that already have capital or access to cheaper capital. I think in all three of these periods, I'd have to go back and look at the chart, but I think we saw interest rates declining, when this recovery happened. And I know we talked about expectations being that interest rates are going to decline again based on the Fed futures, but how much of this spread is really just a result of where interest rates are now, and whether it closes or not would be a result of where they go?
Yeah, that's a good question. I think that it's certainly a factor. If we looked at last year and we looked at the resiliency of the market, a big factor was that the biggest stocks, think Apple and Microsoft, have very little debt. The debt they have is fixed rate. They're now earning more on their cash balances. And so higher interest rates actually benefited them. And you contrast that with smaller companies that have debt coming due, don't have as much cash, they have higher debt to equity ratios, and the perception, and there was some reality in that, is that higher interest rates are worse for smaller companies than bigger companies. But the question here, as you said, well, what's going to happen with interest rates going forward, and how much of that is priced in now to the market given this huge spread? And we don't know, but certainly some of it seems to be priced in, and certainly there's a chance interest rates go down, and by the time they actually go down, might be too late in terms of trying to say, oh, I'll just wait to buy small caps or anything outside of large caps until interest rates go down, because then I'll know it's be good. So interest rates definitely a factor, but I've tested it in the past. It's not as important as you think. Many periods of time where small caps outperform with interest rates rising. So it's not absolute by any means. And what I would say,
the weak breath.
Yeah, so if you turn on CNBC last year, like any random day, you likely have someone on there talking about this. Like, don't trust the rally. No way the market's going to get back to new highs because we have this weak breath. And essentially they're saying the average stock is not participating, small caps are underperforming. What they never do, Caleb, is show their work. Show me the data that suggests this is a bearish indicator. And they don't show that because it would make that statement look absolutely foolish. So I went back in time, back to 1978, start Russell 2000. And I said, well, what happens over the next 12 months when you have this weak breath? You have small caps underperforming. So I looked at the top 10% of periods where small caps underperformed. What happened to the market going forward? Well, as it turns out, market actually does better in the next year. Russell 1000, Russell 2000. So what we showed with those three examples, yes, that you could say that's cherry picking, so to speak, but this appears to be a tendency. But here's the real fascinating thing: the strong breath. So when everything's participating to a large extent and small caps are outperforming, what actually tends to be worse for the market over the next year. You absolutely never hear people saying something like that. So this probably counterintuitive, but if you think about it, there's been some research on it in terms of, well, what's the rationale for this? And it comes down to, in the early stages, after a decline, in the early stages of an advance, so let's say after a decline like 2022, in the early stages, people are hesitant, right? They don't go right into the most risky speculative play. They start out with larger caps, safer companies, so to speak. And as it progresses, as they start to get confidence that this is going to continue, that the expansion is growing. We didn't necessarily have a recession, but market behaved like it in 2022. Then they start to pile into more speculative, risky plays. So by the time small caps are rallying, they caught up, now they're outperforming. Well, now you're closer. It doesn't have to be the top, but you're closer to the end of a move than the beginning. This is all on average. So that's kind of the underpinning here. Will that play out the same way this time around? I don't know, but it's an interesting concept to think about. There's certainly no reason to say that you would expect this gap to be closed with, a crash in large caps, right? More likely it seems that small caps will at some point catch up.
Yeah, interesting. All right, so we've got a little bit of time left before our promised end of the top of the hour, but we've got four, maybe five, four charts to watch in 2024.
I did throw one in there, but it's with one of the four.
All right,
Last
all right.
minute insert.
Uh,
Yeah.
so let's dive into these. First one, we've got this concept of international versus U.S. markets.
So yeah, we don't have to spend a lot of time on this because this is similar to emerging markets, but I just wanted to point this out that it's not just emerging markets. It's not just China. If you take out China out of EM, the chart looks exactly the same, by the way. It's still in a downtrend. It's not as severe the underperformance, but still in a downtrend. And this is just looking at all international stocks, so really dominated by more developed countries like Japan and Europe. And they've been underperforming now for the longest period that we've seen in history. So similar to small caps.
Starting to hear an echo.
It's kind of all the same secular trade here. And this is what we saw in 2022, Caleb, and similar to we had a little bit of outperformance and value that year, and the Mag 7 underperformed. The same thing happened here with international. Actually outperformed in 2022, underperformed last year, and now we're back at relative lows. So I'm going to be watching this for any sign of a turn, any sign of a change. Nobody thinks that the U.S. is not going to continue to outperform going forward because
could be especially seen in an election year too.
Yeah, I didn't put the election in there, but just a quick point on that. Don't make any decisions based on the election. Average performance in an election year is actually higher than non-election year. And
I saw your post on that.
We saw that play out in 2020, 2016, 2012. So this could be yet another time. You saw my post. Yeah. And there's still headlines, which is crazy, Caleb. There's still headlines saying stocks do bad in election years. They don't provide any data. There's a whole narrative about it, but it's absolutely not true. So if you're looking to sell, please find another reason to sell other than the election. There's a million I can think of, but the election is not a good one to use.
All right. Well, here's some relative strength. We've got semiconductors, obviously, have performed really well.
Yeah, big semis and new relative highs here. You could see this has been a big trend. A little bit of an interruption there in 2022, but right back. And obviously NVIDIA, AMD leading the way here. And why I think this is important is semis tend to be a leading indicator for the tech sector. And obviously tech is the biggest component of growth and biggest component for the US market. So if we're going to see a shift in that growth to value, US versus international, a lot of things are playing off of this relationship here. And really semiconductors have become the new gold, as I'll show in the next chart here. Over the last decade, semiconductors up 9x, 824%. NASDAQ 100, 420%. S&P 214%. Gold 56%. And energy 37%. So the new oil, the new gold, whatever you want to call it, it's semiconductors. We use it in everything. And the question is, how much is too much? You look at semiconductor relative strength from 2000 on, it took a long time to get back to new highs after that. And no one knows how. And that's all sentiment driven. That's why I'm going to be watching that chart pretty closely.
All right. Well, this chart doesn't count, though. So we're still 2 charts in.
That's right.
And our third one, another thing we've been talking about for a couple of years, the M2 money supply. And it's finally moving in this direction, right?
a good direction in my view. Yeah, we're good thing we're talking about it because the Federal Reserve just refuses to talk about it. It's absolutely astonishing. They're not allowed to talk about it, and no one is allowed to ask a question about it. And I'm still trying to get in to sneak into a meeting to ask this question. I have a multi-part question, but this will be part of it. And if you have anyone to get me in there, let me know. But until then, I'll continue to say inflation is a monetary phenomenon, as we learned throughout history, and we learned once again in 2022 with the peak of inflation at 9%. And when this was coming lower, we were saying that's a good thing. That's signaling lower inflation ahead. Good news is, haven't started printing money again just yet. We have 13 consecutive year-over-year declines. And so I'm optimistic in the near term in terms of inflation as long as this stays in check.
Charlie, if you keep saying that monkeys throwing darts are going to do a better job at managing the Fed funds rate, that might not be the best way to get into the meeting. But we'll see what we can see if we can pull some strings for you. All right, our last chart I think is one that you always point to as probably the most important chart as far as how people are feeling in the economy, right?
Number one. And if you're feeling good, if you're watching this and feeling good as a consumer, as a worker, just feeling better about your situation than you did 8 months ago, it's justified because likely your wages have outpaced inflation. And the period before that, we went over 2 years where that wasn't the case. And people were very unhappy about that. And it wasn't an official recession, but it felt like a recession because even though you didn't lose your job, your wages weren't keeping pace with inflation. That's the definition of a decline in prosperity. That's what we've seen in countries like Argentina, Venezuela, what we didn't want to have happen here. And thankfully, we got the message. We stopped printing money. Inflation has come down. Hopefully, it stays down. But you want to watch this chart closely for the US consumer because consumer confidence finally, Caleb, is starting to come back. I think this is the big reason for it. It was really in the tank for since that period of higher inflation. People really hate inflation, seems like more than anything else. Uh, and it's starting to go up. And I expect if this continues, consumer confidence will continue to go up. And the US consumer obviously being the biggest part of growth, economic growth, biggest part of the US economy, being very, very important. So watch this. And if this were to turn negative, we talked about earlier, what would be the big shock in terms of the Fed hiking rates again? Well, if they're hiking rates again, this is probably in negative territory. It probably means that inflation's having a second wave higher and it's going above hourly earnings. But where it sits now, and it's going to be the case in January as well, probably going to get around 4% increase in wages year over year in January. Inflation's going to move down to around 3%. That 1% spread is great news. This is extra money in your pocket. You can spend that, you can save it, you can invest it. That's the definition of prosperity for a nation.
All right. Well, thank you, Charlie. I know we're at the top of the hour. Do you have time for a couple questions? We got some good ones in the
Yeah,
Q&A box here.
yeah, for sure.
All right. First one. So I want to tackle this. So we talked about some things that would shock the market. Had a question come in. Are there any popular consensus expectations right now that you think will prove to be wrong, maybe further down, maybe like 5 years from now?
Consensus in terms of investments and markets.
I think so.
Yeah.
It wasn't
So
really indicated in the question, but I think that's safe to assume.
yeah, it would. I mean, it's hard. It's always hard to say what is consensus, right? But I would say, looking at some of the charts that we looked at today, it would be hard to imagine that the consensus wasn't expecting 5 years from now to have Mag 7 US large cap tech growth continue to outperform. That would, to me, that would have to be number one. Now, what, how do you play against that? Should you be betting against that or anything like that? I think that's a difficult game to play. Most people shouldn't play it. They should just make sure that if that were to happen, it wouldn't hurt them in terms of we've seen huge manias in many different areas, and the best protection during a mania. You could call it a mania, or you could call it not. Many people are saying it's justified based on fundamentals. Whatever the case may be, the consensus seems to believe that it's going to continue. And if they're wrong, you have to have something else in your portfolio. So the answer to these consensus bets, I would say, is not don't invest. It's to be broaden your investments. So like if we look at Japan, let's say at the end of 1989, a lot of people bring up Japan whenever I talk about long-term investments, and they say, "You see, Charlie, didn't work out for people who bought at the peak in Japan in 1989. Therefore, you shouldn't invest." Right? And no, the answer to that was not that people in Japan shouldn't have invested. It was that they should have not had only investments in their home country, and in Japan, especially not when it was trading at a multiple that we'd never seen for a stock market that large, right? So just the consensus was things are going to be so good for the future of Japanese companies that you could pay almost any price. I don't think that's the same scenario for US large cap growth. It's not, as we've talked about, not as extreme as 2000. Certainly, the level of retail participation or enthusiasm isn't the same. There are differences, but that would be the number one consensus, I think, opinion is that, and for good reason. It's been so long, and everyone uses the products with that's going to continue.
All right. Next question here. Let's see. So I'm going to paraphrase a couple questions and think back to, I think it was maybe two webinars ago where, you kind of made a public service announcement about having your cash in high yield savings accounts. And when yields get higher, that's good because you can buy bonds and you can get those interest rates. Is it still a good time to buy bonds, or are you concerned about the, I guess, capital risk of buying bonds now that they've had such a run?
That never buy bonds when your holding duration is not matched. So if you don't have, the duration of like the average bond fund, you're looking at, 5, 6 years. If you don't have that time period, don't buy a bond. Put your money in a savings account, money market fund, whatever, right? Where it's liquid, you can get it out when you need it. Because as we've seen, yeah, interest rates are better today. They were better when we had that webinar. They were really good, right? They're looking at 5%. What I said at the time is there's no permanence to that yield in cash, right? That 5% you're getting, as soon as the Fed cuts rates, it's gone, right? And that's expected to happen this year. It may not happen, but it could happen. What we also talked about is that bonds, longer term bonds, tend to do well during rate cutting cycles, much better than average. So perhaps that's coming, and you don't want to wait until after that cycle to get into bonds. You want to buy beforehand. So 10 years come down. I mean, it went down way more than I thought it would. I mean, it was one of the most extreme moves we've ever seen. It went from a little over 5% to below 4% in like a month and a half. It was unbelievable. So no, you shouldn't be as enthusiastic about bonds today as back then, but still 4% is better than the 2% we were seeing, and certainly better than the close to 0% we were seeing in 2020. So my only expectation, if you're bonds, you have a 5 to 7 year holding period, you should expect 4 to 4.5%. I would say that should be your base case expectation. If interest rates go down, you'll make more. If they go up in the short run, you'll make less. But if you can hold it for that period of time, you're going to come out between 4 and 5%, and it's there as a cushion in case the equity markets don't do as well in the next 10 years as they've done in the past. You can rebalance, use that portion of your portfolio, and if interest rates go down, well, now you're going to benefit from that as well. So just make sure, if we learned anything in the past few years, make sure that you match your own duration to the duration of bonds. They're not a risk-free instrument, particularly not longer term bonds. 10-year, 30-year treasury bonds, very sensitive to changes in interest rates. And the crazy thing, Caleb, is that 30-year treasury bond, it acted way riskier than the stock market during that, the last few years. And that's kind of shocked a lot of people because bonds are supposed to be, low risk or risk free. A lot of people, it's a risk free treasury. Yes, you will get your money back in 30 years plus that coupon payment. But if interest rates go up in the short run, There's massive price declines that you're going to have to sit through.
All right. All right. Last question we'll take, and then we'll wrap up. Had a couple of
Yeah.
people ask about energy and why energy is not performing.
Why it is not performing?
Yeah, I think let me
Oh,
read the
last year. Yeah.
question. Yeah, so
Well, yeah.
why is energy underperformed despite the fact that recession hasn't come in? And then another question just on energy and anything specifically that you're seeing in the charts.
Yeah. Energy is a tricky one. It's very tied, obviously, the correlation to the price of oil. And the price of oil has a lot of different inputs. And sometimes it's tied to the economy and how it's doing. Sometimes it's not. It's applied, different levels of supply, production. So it's a complicated animal. If we look at last year, energy basically just went sideways. It had a huge run in 2022, 65%, I think it was up the XLE. It was standout, right? Almost everything else was down. Yeah, maybe staples were up, a few defensive areas, but it was uh, it was a huge outperformer. Last year essentially went sideways. Crude oil, not surprisingly, went down last year, so that hurt it. And if you look at the energy sector, where it is today, I'd say sentiment is much better than where it was a year ago. People were very optimistic, obviously, after that 65% decline. But in the short run, it's, if crude oil goes to 40, I'm sorry, energy's going to get hurt. If crude oil runs back to 100, it's going to do very well. I mean, there's no way around it. I don't particularly like sector bets except when there's some type of extreme. In 2020, we talked about energy being at that type of extreme. I mean, it was just so beaten down. You had crude oil futures turning negative, which is kind of unfathomable. That seemed like a time where if you're going to make a sector bet, it's a pretty good bet. And it ended up being the best performer in 2021 and 2022 again, and then again sideways last year, but nothing huge. So we're gonna need energy. Like it's not going away. But to me, predicting the price of crude oil is harder than much harder than predicting the price of the S&P 500 at the end of the year. So I have no long-term bets. It does energy. Nice thing about the energy sector does behave differently, less cyclical, I guess, or than, like let's say industrials or consumer discretionary. So you get a little bit more of a diversification benefit. It was a value play. It still is somewhat of a value play depending on what you're looking at. So you
What was a
have different
drag forever,
factors. Yeah,
right?
I mean, it was a huge drag for a long time, and nobody wanted it. Sentiment was so low, but just look at the chart. Like the run up was so enormous. Like now it's probably closer to, I guess you would say, fair value. But fair value is so dependent on the price of that underlying, that in the short run, that's what's going to drive it. When the best periods for energy historically in terms of outperformance is when crude oil is outperforming other commodities. So if you think crude oil is going to go to 100, probably energy is going to be the best sector this year. And if you think it's going to crash, and you think the recession is coming, that's the other thing, right? That's funny about energy, right? It's a lot of people use it as a somewhat, I don't want to say defensive, but saying like, I'm betting on oil prices going to go up because I think things are going to get bad, right? There's conflict, and then they see a recession hit and price of oil gets slammed like we saw in 2008. Energy stocks get killed, and that kind of protection that they were looking for doesn't really happen. So if you're buying energy as a play on like uh, you know Armageddon, gold was probably a better bet than that. And I
All right,
wouldn't
well,
bet on that to
we'll
begin with.
wrap up on Charlie being bullish on gold. So, um,
There you go. Slice that out.
yep. All right, Charlie. Well, honestly, though, thank you so much for joining us again. Really appreciate it. Always love our conversations and learn a ton from you. Quick reminder to everybody to check out your blog routinely and follow you on X. And we will do this again in a few months and look forward to hopefully seeing everybody then.
Absolutely. Thank you, Caleb. Always a great time. And thanks everyone for joining us.
All right, bye everybody. Thanks, Charlie.